This quote is by Ed Yardeni, Yale PhD economist. If the Fed persists in flooding the markets with liquidity, the risk is that the Fed will create the biggest financial bubble of all times. And I believe we're this bubble ranks among all of them. And the one that I can cite from my life is in 1999. First, a comment about what's going on the streets of our cities. This very much feels like the French Revolution, which you probably know from history. Robespierre led the revolution, and they tore down all the monuments to religion and to the country's history, those things that the culture held dear to their heart, that defined the culture. And that's how they were able to, basically perform a coup. And so I just thought this was a fascinating slide. Here's Lady Liberty hides from the hoodlums. So I mentioned 1999, and this references to a Prince song, We're Gonna Party Like It's 1999. In webinar 4, the last one, we talked about the debt bubble. And since the COVID crisis, the corporate debt issuance has hit a record after record with $1 trillion in investment grade issuance year to date. And the federal government deficit is now projected to hit $3 trillion plus this year. And by the way, I want to let you know, it took 192 years of our country's existence to reach the first trillion of federal debt. And here we've done it in 30 days. So clearly we're making progress. The Fed, by keeping interest rates low, is making it painful to own treasuries, and they're pushing investors into risk assets. So as you can see in this line, it is going through the floor. The next question is, will they stop at zero, or will they allow negative interest rates? As I understand it, the Fed will have to change their charter to allow negative interest rates, and I will tell you that they're going to do it. They're going to get there. The economy's too fragile. The market's too fragile. It's built on a bubble, and I do believe that in time the Fed will be moving to negative rates. Just to let you know, I'm making that prediction now. Hard to imagine. It will again require a change in the charter, but it is certainly possible. And here's what the Fed did during the COVID crisis. This is just money flows in and out of bond funds and ETFs. So again, the bond market essentially, far left, you can see a huge decline in investment in the bond funds and ETFs. In other words, investors were fleeing. Then the Fed announced on March 23rd their giant QE everything program, and it made it safe for investors to go back into these bonds. And boy, did they! With the Fed, they invested with the Fed. Here's the Fed's balance sheet and the Treasury debt, and they're growing lockstep, which means that the Fed is buying the debt, essentially. They're monetizing our debt. We've been over this before, but that is a very instructive chart. Here's the fiscal deficit. It's going to be the widest since World War II. In the middle of World War II, we had to finance our fight on both shores, the Pacific against Japan, and of course in Europe against the Allied forces. And we don't have a war today. Maybe you could call COVID a war, but the truth is this is in peacetime. And up until COVID, we were not in a recession, and yet our deficit spending is hitting records there. So that's very ominous, let's say. The Bank of England's doing the same thing. This is the balance sheet of the Bank of England. Again, exploding over the last decade. By the way, China is similar. This is just outstanding dollar bonds issued internationally by Chinese domiciled borrowers. Again, to the moon, Alice. And then here, China's economy depends on stimulus. Look at this one. The green stripes are when the government of China is stimulating, and that is spending money through programs, infrastructure spending and other programs. And you can see there in 2009, the great stimulus binge of 2009 was unprecedented, where they built roads and bridges in whole cities that are still not occupied. And you can see the blue line is financial conditions index, just basically how the economy is doing. And notice how when they finish their, each period, the green period, when they finish their stimulus spending, financial conditions weaken. And they spend and then they weaken, and they spend and they weaken, and they spend and they weaken, and here we are again. So it's not just the United States, but China's a basket case as well. Here's M2 money supply growth. M2, they've taken away M1. It used to be base money, which is just dollars in circulation. M2 is what they call near money. It includes checking accounts and money market funds. So it's almost cash. And you can see where it is absolutely unprecedented and growing at a very, very fast rate. By the way, the velocity of money is collapsing, which means that the transaction volume of money, meaning the transactions happening, in the economy, are way down. So this money, where's it going? Well, I'll tell you where some of it's going in a minute. So this is a $3 trillion increase in the money supply. This comes from the fabulous St. Louis Fed. They call it Fred. Whenever you want statistics on any of this stuff, and I know you do all the time, you can go to Fred and find pretty much anything you want. This is M2 money stock, and it shows a $3 trillion increase. And it magically leads to a $3 trillion increase in equity valuations from the March bottoms. So it was almost directly, infused into the capital markets, and it made its way by hook or crook into the equity markets. And so there you have it, dollar for dollar. $3 trillion increase in the money supply, $3 trillion increase in equity valuations. Get rid of that terrible thing. This is U.S. corporate borrowing. You can see where in 2020 it escalated significantly. This is corporations, and this is debt issued. So borrowing was at a record, and during the COVID crisis, it increased by $1 trillion. Year to date, a record by far. Here we are. This is debt issued this year. So the blue is 2019. That's for comparison purposes. A lot of it's investment grade. Here are corporate bond defaults. So in the midst of the money printing, the giant federal government deficit spending, the unprecedented issuance of bonds and debt creation among the corporate borrowers, you also have a record amount of corporate bond defaults. These are companies that cannot pay interest anymore on their debt. And by the way, this number is going to increase substantially this year. That's the US and rest of the world. So it's a big deal, and it's just begun, honestly. There's a lot more to come. That's why I'm telling you, the Fed's probably going to lower rates into negative territory. They have to, because we're just, especially if COVID picks up again. So we're doomed. This is the number of companies that can't pay interest. They're zombie companies. They're almost 20% of US firms. I've dwelt on this in the last several webinars. These are 60% of NASDAQ companies had junk bond debt coming into the COVID crisis, and it's much higher now. So I know of 2 companies locally that have filed for bankruptcy finally. By the way, Chesapeake Energy's filed for bankruptcy, and the stock goes up. Hertz filed for bankruptcy, and the stock went up several 100%. And I'll tell you why in a moment. Anyway, this is ominous as well. So I'm going to compare the speculation, ironically, amidst all this bloodletting, this deficit spending, Fed money printing, debt issuance by corporations, and then defaults. You've got speculation that we haven't seen since 1999. Wait till you see these charts. Anyway, back in 99, CNBC had emerged in the mid-90s as a major media force. You had a guy named Dan Dorfman. You old folks will remember he was a carny barker promoting stocks on CNBC. And he actually got in some trouble for buying the stocks and pumping them on CNBC, and he had to step away from his role. Day trading was born in the late 90s, 98, 99. I know in Atlanta when I was at SunTrust Robinson Humphrey, there were companies opening up office space for day traders and renting out just cubicles. And they were filling these cubicles up with people that are quitting their job to go day trade. Right near my house in Atlanta, there was actually a shooting. It was all over the national news. A guy shot a bunch of people in the day trading floor and killed himself, and that was like at the height of, by the way, this trend. Remember getting stock tips from waiters and taxi drivers, and there were a record number of IPOs in that period as well. So here we have today, we have Dave Portnoy, who you may have heard of. He's the founder of Barstool Sports. He's got a video blog and 1 million followers, and he talks about sports. And he sold his company to Penn National Gaming because gaming legalization is taking place all over the country, state by state. About 16 states have legalized gambling for online gambling, which is going to be huge, of course, sports gambling. And this Portnoy is the new Dan Dorfman, and he's got more viewers than CNBC. And he calls it Davy Day Trading Global, DDTG. You can Google it. It's outrageous. I don't recommend you spend much time. It's offensive, to say the least. Then Twitter is giving stock tips in worthless companies like Hertz. And where's the SEC? I don't know, but they need to be paying attention, because there's a lot of pumping and dumping going on here. And then there's a record number of blank check companies. These are called SPACs, special purpose acquisition companies. They go public without a business. They get a CEO who's got maybe a track record. They go public, raise money, and then they shop around for a company and merge it, and then create a narrative, and the stock shoots the moon. And they are very sketchy. We're going to go through some of this now. Oh, here's another consequence of the bubble. You have 5 stocks driving the S&P. Look at that. Facebook, Amazon, Apple, Microsoft, and Google up 23%, with the S&P down slightly. There you go. When you have this kind of market dispersion, meaning dispersion of performance, very narrow among 5 stocks, it's very, very, how do I say, it shows a lot of risk. It's not healthy, just letting you know. So if you don't own those stocks, you're not winning. Eventually, this game of, say, musical chairs will end. Blank check companies, the number of SPAC IPOs, look at them rising. That 2020 is a projected number. These are blank check companies. Again, remember, they raise money with a shell. They have no business, and they go and hunt for and buy a business. And there are a number of these that are out there that have caught a wind on Twitter and caught a wind from the Robin Hoodies, and they're high flyers, let's say. Anyway, that's a sign of the speculation that I'm speaking of. Government payments right here. This is again from Fred. This is the personal savings rate. Look at that skyrocketing in COVID. Why? Because they sent out $2 trillion in the form of PPL loans, right, which are forgivable, and unemployment compensation during the COVID lockdown. So all these people got checks, companies got checks, individuals got checks, and they had nothing to spend the money on. Nothing, because everything was shut down. So there's the savings rate. So that's why we have so much cash on the sidelines, they call it. And so, of course, this money will be depleted once these people are not hired by their companies again, and unemployment grinds on and on and on, which I think it will. But there you go. And guess what they've been doing with it? Investing on Robinhood. So this is Dave Portnoy, Davy Day Trader Global, DDTG. This is the guy, and this is what he looks like. And he's broadcasting live on Twitter, and he's day trading and barking out tickers. And he has millions of followers. And then those followers have millions of followers. It's like a pyramid scheme. One guy squawks, and it's echoed through an incredibly large echo chamber across the Twitter sphere. Portnoy has more viewers than CNBC right now, right here. Try that one on. So look to the left, social media. Through Twitter, Instagram, Reddit, and TikTok, you've got like 5 major influencers with 100,000 plus followers each. And then you've got 30 influencers with over 10,000 followers, and hundreds of thousands in the chorus with retweets and likes. And they're all doing the exact same thing. Over on the right, there's this phenomenon called Robin Track. It's a service provided by Robinhood. For those of you who don't know what Robinhood is, it's a new free trading platform. When I say free, they don't charge for trades. It's Robinhood that caused Charles Schwab to quit charging for trades, by the way. And what they do when you sign up for a Robinhood account, they give you 1 free share of stock, and it's usually in a penny stock. And the stock, ironically, always goes up. And then you sell your share, and there you've got your investment capital, and you start trading from there. Maybe mommy and daddy give you a few $100s, or maybe you got it from your unemployment check. And you start wagering it on Twitter, and it looks very, very easy. You just follow the leaders. So we can track Robinhood activities through Robin Track. I'm going to show you some charts. I've been shorting these stocks in my hedge fund and making some good money on it, by the way, full disclosure. We've figured out the cycle. We've identified the influencers. We've identified the when, like when they start chirping on a stock. And then we watch the stock be taken up by the Robinhooders. Then we check on Robin Track for the number of accounts that are buying the stock. And then we give it a couple of days. And then next thing you know, it retraces. And when I say retraces, I'm talking hundreds of percent in many cases. So I hope this never ends personally, but I'm afraid the SEC is going to have to do something. Anyway, tracks how many users are holding a specific stock and the price action. And it shows the most popular stocks for the day and the week. And I'll show you that. Ranked, by the way, by the number of holders, buyers, and so forth. Here's a snapshot of a guy's Twitter account. And you can see on the left, he has 4,700 tweets. He has 51,000 tweet impressions, 1.95, I think, is that million? Million profile visits, 51 million tweet impressions, 49,000 mentions, and 61,000 followers. So this is an influencer who has this following that likes and they retweet what he says, and that goes out to who knows how many other Robin Hoodies, they call them, punks, amateurs, who are wagering their $600 stimulus checks on the market. So you tell me right now, does this seem like a speculative bubble to you? I'm just asking. I'm really not sure. Oh, look at this. Here's Portnoy's quote. Get some letters in your portfolio and watch them go up. It's that simple. Just some letters. Anyway, here's a total number of stock positions at Robinhood. That's 30 million, by the way, 31 or 2 million. Pretty impressive, huh? I wish I'd come up with it. I've been trying to get young people to get excited about the market and economics my whole life. I can only do it one by one when I get great interns from Sewanee and Kenyon College in places. I can get them excited, but it takes a lot of one-on-one time. Here, this guy's done it just by saying, put some letters in your portfolio and watch them go up, and he suckered in millions of people. Here's a snapshot of what it looks like on Robin Track. These are the top 11 companies this week, and that's the percent change in the price of the stock. None of these tickers you recognize, of course. They're all penny stocks. Some of them are worthless. Some of them are blank check companies. Some of them are Chinese that you can't even identify what they do. Other ones don't even have a particular product. We've done a lot of work to try to figure these out, and really it's almost like walking into a cave, dark cave without a flashlight. There's no information on a lot of these. And the one on the right shows a 24-hour period. Look at those returns in 24 hours. I guess you could call these herd investors. It's a company called SHIP. And Dave Portnoy there on your screen to the left, I bought the stock SHIP simply because I consider myself the king of the cruises. And I wanted all ship stocks. I literally couldn't afford not to own those letters. It's up 45% today. By the way, it's a dry bulk shipper. Okay, very economically sensitive company. And every other dry bulk shipper stock is down to like multi-year lows, but not this one. Look at that chart. It's flying because he likes to go on cruises. Speculative bubble yet? Are you with me? CIMIG, CIG.C. This is a Chinese company. 275% boom bust cycle lasted 2 hours. There you go. The green line is the number of Robin Hoodies that own the stock. The pink line is the stock price. Indivior. Indivior has a narcotic that is treated to treat narcotic addicts. Opioid addicts that take Indivior's product, which is basically a milder narcotic to wean themselves off the drugs. They issued a press release. It wasn't the result of an FDA trial, which of course requires great rigor. It was a press release that said there was an informal survey of their patients, which they verbally indicated that they were not using drugs anymore. So these are opioid users, okay, drug users. Now, let me ask you, for any of you who happen to know a drug abuser, when you ask them if they're using drugs, what do they say? No? Well, my guess is this is not good data. Tortoise Acquisition. It's a shell company, okay? Like I said, it's a blank check company. Somebody got on it. It'd been around for several years without an acquisition, and here we go. It gets a Robinhood follower, a leader. There's the price, and there's the users holding. Here's this guy, Portnoy there with his pizza box. And look at this guy. Here's another amazing quote. I used to dread waking up at 7 a.m. for work. And now up before 6 a.m. and ready to watch and trade stocks. I love Mondays. I've been trying to get young people to look forward to work my whole career. I've been trying to get myself to look forward to work. Little did I know. And look at his tickers he's on. There's SHIP. And he's on SHIP, not because it's a dry bulk shipper tied to the economy. It's because Portnoy likes to take cruises. And the ticker is SHIP. And it all makes sense, doesn't it? Now, this is another one that was interesting. Tomorrow is Juneteenth Day. Now, Juneteenth, of course, is the new holiday that popped onto your Google Calendar without you knowing recently. And apparently it was commemorates the day that the Emancipation Proclamation was signed, which I'm very excited about that. Didn't know it existed as a holiday, but happy to have it. A bunch of leaders on Twitter and Robinhood decided that their legions of followers should support Black-owned businesses. So they just started buying them. And what they bought were some penny stocks, of course, that were valueless. We looked at the stocks, and frankly, don't think I'm terrible, but I shorted a couple of these too, and boy, did they pay off. One in particular is a bank that has never made money, that has been on life support. The government owns a convertible bond, otherwise they'd be gone. They've got negative return on equity, negative return on assets. Stock jumped from $1.80 where it'd been for a decade to $9. And then, by the way, it's on its way back down. No, $17. Sorry, on its way back down. This is that bank, Carver Bank Shares, at a one-day 10x jump right there that you can see. And this is the ugly side of this whole thing right here. So the 20-year-old Robinhood customer dies by suicide after seeing a $730,000 negative balance on his account. So this is one of the obviously terrible consequences. You think these kids are in over their heads? By the way, from what I heard today, it was a mistake. He didn't know 730,000. He misread it. So there you go. Easy to pull the trigger on a stock trade. It's hard to pull the trigger, when you're going to kill yourself. So to me, that's just terribly troubling. And I wonder when the SEC will get involved. Oh, to my favorite topic of gold, and then I'll cover the election because everybody's asking me about it. Gold is, I think, something that wealthy people and anything to lose should have an allocation to of about 5%. And the reason is because it's been a store of value for 4,000 or 5,000 years of history. It's not a promissory note like a dollar. Remember, a dollar, printed money, is a promissory note, which means it's a debt instrument technically. This is not. This is currency. It's thought of as currency around the world. And by the way, central bank buying of gold is reaching records by the day. China, India, Germany, Poland, Southeast Asian nations, loading up on gold. The bullion, the physical. And I'm not advocating you own gold necessarily, the bullion, the physical. But there are great ways to play it. And managers are underweight gold, but they will not be for long. Gold is at now 1,760 or 70 an ounce. It's approaching decade-long highs. It's going to break out to 2,000. I told you that. The way to own it is through the miners. This is gold in reserves. This is just the gold in the ground. The one thing about gold is you can't print it. You saw the money supply increase, right, on that chart. So the amount of dollars in circulation, British pounds in circulation, euros in circulation, yen, yuan, through the roof. But gold has about a 1.5% supply growth a year. So there you go. It's disinflationary. Gold performs extraordinarily well during negative market periods and negative economic periods. You can see here from 1976 to 78, S&P was down 20%, gold was up 53.8. In 1987, the big hiccup in 87, Black Monday, market was down 33.5, it was up 6. 1990, that was a little recessionary period, S&P down 20, up 6.8 for gold. And then again, 2000, the internet bubble bursting, down 49% for the S&P, up 12.5%. 2007, during the Great Recession, Obviously, gold outperforms considerably. And then in 2011, when the S&P downgraded our debt, August of 2011, you may remember that, the stock market fell about 1,200 points in 2 days. It was spooky. And by the way, the CEO of S&P rating agency had to step down from his job less than a month later. I keep thinking they're going to downgrade our debt. They did. They downgraded Canada's debt yesterday from AAA, the highest rating, to AA+. They did that to us in August of 2011. Okay. S&P, the ratings agency, had the audacity and the gall to honestly, rate our debt and downgrade it. And the pressure, the political pressure was so extreme. Again, the CEO left the company within a month. So the question is, what's going to happen to the ratings agencies now? If you're the CEO of S&P or Fitch, you downgraded Canada yesterday. The U.S. fiscal situation has worsened dramatically. I mean, many times worse than it was in August of 2011. We're due for a downgrade, aren't we? Oh, no, not if you're the CEO of those companies. You'd lose your job, maybe be arrested. This is the dilemma we're in, gang. It's a manipulated market. It's completely out of control. And anyway, one of the biggest risks to gold would be rising yields, just to let you know. But the Fed is controlling the yield curve. Remember the chart I showed you earlier of interest rates going to zero, and I predict they might go negative. They're going to manage the yield curve, which means they're going to control that. They're not going to let them go up. They're going to hold them down until the bond vigilantes win, and who knows if they can beat the Fed. Bond vigilantes, go look it up. So there you go. That's the end of my riveting webinar, and I'm going to go back and see if you have any questions. Do you have any questions, gang? Please ask questions. Somebody asked me about the election and the polls. Oops. Q&A, any questions, gang? Have a question. I got to find it first, though. Here we are. What about the polls? So I forgot what somebody I follow on Twitter, and I don't follow Robin Hoodies. Oh, another question about the polls. You guys are sharp. The polls are wrong. That's not because I'm a partisan. Remember, in my opinion, neither party has a monopoly on bad ideas. And I can pick Republicans and Democrats alike and lambaste them, from Richard Nixon and his wage and price controls to George Bush, W, and his ill-advised war in Iraq and him signing the ethanol mandate, which is one of the greatest boondoggles in the history of U.S. government. And then there were great Democrat presidents, including Bill Clinton, believe it or not. Lousy man, that's true. Immoral man, good president. And so again, neither party has a monopoly on bad ideas. About the polls, what matters for investors is to get the right information, the right data, and make a good, reasoned judgment about it. And the polls show that if Biden has a double-digit win, well, double-digit lead. We have two great interns at our firm. And if you're looking to hire some very, very bright kids, I got them. Come to me. And I asked one of them to look at the latest polls, because we found in the past that they routinely poll more Democrats than Republicans, significantly more. In the 2016 election cycle, we found, and I wrote this on Forbes, and you can go hit Land Street go to Forbes.com, Land Street, and you can see my article on the polls going into the 2016 election and how they routinely polled 8 to 12% more Democrats than Republicans. They're doing it again. The New York Times poll that came out that got all the attention today or yesterday had a huge number of Democrats relative to Republicans. Every single one of them is polling more Democrats than Republicans. And even it looks more like a 4-point race. Okay, that's the truth. I'm getting ready to write another article on Forbes. You can see the data. How do we find it out? It takes about 30 minutes per poll to find the data of who they're asking. By the way, and the reason it matters is because Americans identify equally as Republican and Democrat. Just like 31% of Americans say they're Democrat, 30 say they're Republican, and the rest are independents. So it's kind of split equally, right? But in every single poll, they routinely, poll 10% more Democrats. So I don't know why that is. I was asked today, why is that? I don't know why, but it just is. We have the data. So I'm going to keep doing, if I do further, webinars, I'll keep you informed. It's important to know for your investment portfolio who wins this election, because it could not be a wilder and more consequential election. And I will say that, this is, it seems like to me with Joe Biden greatly compromised now, it's obvious mentally. I have a mother who's aging 96, who's losing memory and so forth. And I see the same traits among Joe Biden. And I think that he's a shell now, and he is a talking point. And underneath him is a wild-eyed group of rebels and Marxists. This is an election between, I think, civilization and anarchy. So that's my analysis of the election. Outlook for healthcare stocks. Well, they're probably going to do well because of demographics, okay? That's for sure. And government spending will increase, okay? So I would say healthcare stocks get a bid. I'm very excited about some developments. For instance, in the COVID treatment area, a little name I like called Cytodyne, CYDY, has a promising treatment, not a vaccine. Keep in mind, gang, there's still no vaccine for HIV. There are vaccines for the common flu, but it morphs so often that it's not that effective. So everybody who thinks we're going to have a vaccine, the odds are that we don't. Like Moderna, mRNA is the ticker. This, I think, practically fraudulent company is, touting their vaccine. I don't think, my guess is, and I'll be shocked if I'm wrong, there won't be a vaccine for years, if ever. Now there will be treatments, and there's some on the horizon. I think Cytodyne has one. By the way, I say that I'm not supporting you buying Cytodyne or anything. I'm not promoting anything here. No, I'm not recommending stock ideas. All right. In percentage terms, how large a collapse are you predicting in the S&P by year end? Great question. I don't know that I'm predicting a collapse because of the Fed. Okay. I'm trying to determine how they're going to lose control of the market. The only reason you own stocks today is because of the Fed, okay? It's not because of earnings growth or revenue growth or fundamentals or a good economy. You do not own stocks for that reason. You own stocks because you can't own bonds. They don't give you any yield. And you think the Fed's gonna have your back. That's why you own stocks. By the way, that kind of investment makes me sick. So I'm not predicting the S&P melts down by the end of the year necessarily. I could easily see a meltdown, and the Fed will just buy stocks. So there could be a meltdown. Here's what I will tell you. The recession is going to end slower than people think. It's going to be a bad recovery. There will be a V up until a certain point, and then it's going to be disappointing. By the way, when you look at these ISM numbers they tout, they're up month over month. So when you see a 50% increase or 20% increase in this, don't get excited. That's month over month from the depths of hell. That's April over March or May over April. Whoop-de-doo, gang. Seriously, they're not even consequential to the well-being of the economy. And yet the talking heads on CNBC pretend that they mean something. They don't. They're month over month. Please know that. So again, weak economic recovery, pervasive unemployment. If COVID comes back, that's guaranteed. A Fed that is propping up the market by money printing. Own gold and silver. Question about, come on, anymore? Oh, here's a bunch more. Sorry. If the economy is bad in the fall, will that suggest Trump's on his way out? People usually vote their pocketbook. That's true. And so I don't know about that. And by the way, in the New York Times poll, which I just cited, polled many more Democrats, the only area, and if you've been listening to the news, you know this, where Trump wins is on the economy. So I don't know what that means. That's a good question. Should we hang on to our FANG stocks? Probably. Yes, and maintain your 5 to 10% gold allocation. I'm afraid, yes, I think you should do. I mean, you got to go to the deep, fast part of the river. They're the companies that are solvent. Okay. They're gaining share in many cases. So yes, good question. FANG stocks will probably continue to work. How do I see the end game for the national debt playing out? Higher taxes. They won't cut spending. Trump's had some good policies. Okay. He cut tax rates. He, while deregulator, he's deregulated significantly. His instincts are good. I got to tell you. I mean, the trade war, I can't tell you that I love that, but China was a bad actor. That's for sure. And nobody had the guts to do anything about it. He killed that Iranian general and shut them up. He's done some pretty good things. I wish he would talk about the deficit. I wish they would address spending. So that's the problem. And if the Democrats win, you'll see highest marginal tax rates at 70%, the same place they were in 1972, by the way. So hide your wallet. So higher tax rates will be the result, not spending cuts, unfortunately. Is there any way the market makes it through the next 5 to 10 years without realizing the consequences of the bad behavior now? No. I think there's going to be a train wreck, and I think it'll be is bigger than the COVID train wreck. Every 10 years, you had the internet bubble pop, and that was brutal. 10 years later, you have the great financial crisis. It's brutal, which was built on debt, right? Home mortgage debt and speculation, okay, among participants in that market. CLOs, collateralized loan obligations, collateralized debt obligations. And then it blew up. And then you had this recent COVID crisis, and that too was built on a mountain of debt. And the debt is growing. And the question is, can the Fed prop this market and this economy up forever? No, the answer is probably no. And the more debt we take on, both as a government and at the corporate level, the greater the risk is for a debacle, a bloodbath. So that's a great question. I really appreciate that question. Here's another one. Jeremy Grantham, who everybody respects, recently stated that we're in one of the top 10% overvalued markets. I think relative to an economy in the bottom 10% of historic comparisons. How does one build a portfolio when you have a overvalued market and a very weak economy? So the question again is, where the market itself is in the top 10% of valuations, and it is. So I would argue it's at a record. And then the economy's down here. Well, that's a heck of a question. It's very difficult. I would try to find some good dividend paying stocks because you can't find yield anywhere. Okay, commodities are going to do well. I happen to be the only person, one of maybe 10 people I know, who think there is an inflation scare. Nobody asked about it. An inflation hiccup coming. And so I think 5 to 10% allocation to gold in case of a total market meltdown, blow up, economic meltdown, and then also inflation. And a devaluing of currencies. When you're printing money like we are in the US, and they are in Japan, they are in the euro, and China, fiat currencies lose their value relative to other things, including hard assets, which are gold and silver and land. And I mentioned this in the last webinar. Commodities at some point will get adrift. So remember, inflation is too much money chasing too few goods, right? We know where the too much money is coming from. Where's the too few goods coming from? That quote, by the way, I think it comes from, is it Joseph Schumpeter? Maybe, I hope, or Milton Friedman, I think Schumpeter. And I think that the too few goods is coming. The interruption in the production of goods and services. That's a Milton Friedman quote. Thank you. That was a former intern of mine that came up with that answer. Oh, and Tom Singleton too, who knows everything, by the way. The too few goods thing is something we dwell on all the time as it relates to inflation, and I think we're going to get too few goods. You've already seen an interruption in the food supply. If you look at food prices, they're up 24% year over year, not just vegetables, but meat, proteins. I think that might be a start of something. I think that with all these defaults of worthless companies that have underpriced their goods because investors were looking the other way, they're going to have to raise prices on services. And then I think, of course, the disruption of globalization, but really China as America's, manufacturing hub, the disbursement of the manufacturing back to the U.S. or to Mexico will lead to higher prices. We won't know for a while, but I think that the real surprise around the corner that's going to blow everybody out of the water is a whiff of inflation. Inflation statistics are flawed. You have to really look into the CPI to find them. 29% of the CPI, FYI, is something called owner's equivalent rent. Owner's equivalent rent is a survey. They call homeowners like me or my wife and ask us, what could we rent our house for this month versus last month and versus last year? So even I study the market for a living. I live in it. I breathe it. I still might not know the answer to that question. The most scientific I'm going to get is maybe to look at my mortgage and add $100 if I'm bullish or subtract 100 if I'm not. It's terrible, and it's 29% of the CPI. Here's another thing. If food prices are rising, let's say protein prices are rising, say beef prices are rising significantly, they're going to assume that you trade down from beef to something cheaper, maybe pork or chicken. And so they adjust, assuming you're going to trade down. So they don't properly reflect the increase in the price of beef because they adjust it for what they perceive your behavioral response will be, which is to trade down to protein. So they're manipulated. Anyway, I think that could be the surprise. Okay, gang, thank you again for attending my, fifth webinar. And I really don't have a closing joke for you because I'm basically made myself sick talking about all this. But I love you very much. And if there's anything that we can do for you at Trusco or N3L, answer questions, look at, evaluate how you're doing things. If you need another set of eyes on your, your portfolio or your strategy or your entire asset, everything you own, we do that for people, but we're glad to do it. So anyway, once again, thanks for attending, and you're the best, and I hope you have a fabulous weekend.